Welcome back to the deep dive. Today we're jumping straight into something, well, really fundamental for understanding a business. It's financial statements.
Exactly. These aren't just random reports. They're interconnected summaries telling a company's financial story.
And we sort of touched on the basics before, right? Business structures and that core accounting equation.
Yes. Assets equal liabilities plus owner's equity. Or, for corporations, assets equal liabilities plus stockholders' equity. That idea is key here.
So our mission today.
To really get to grips with the four main financial statements, and crucially, see how they actually talk to each other. They're linked.
Okay, let's start then. First up,
Yep.
the income statement. What's the main takeaway there?
Right. The income statement, it covers a specific period, like a quarter or a year. It basically adds up all the revenues.
What money coming in?
Exactly. And subtracts all the expenses, the costs of doing business.
And the result.
It's either net income, a profit, if revenues are bigger, or a net loss if expenses went out. And that bottom line, that's super important for the next step.
Ah, so it leads somewhere, which is the statement of owner's equity.
Precisely. This one tracks how the owner's stake in the company changes over that same period.
Okay, how?
Well, it starts with the beginning equity, adds the net income from the income statement.
Or subtracts the net loss, I guess.
Or subtracts the net loss, yeah. Then it accounts for any money the owner put in investments or took out, which are withdrawals.
So it's like a bridge, connecting the income statement's result to what comes next.
To the balance sheet, exactly. It calculates that ending owner's equity figure.
Gotcha. And the balance sheet, I always think of this one as like a photo, a snapshot.
That's a perfect way to put it. Unlike the income statement covering a period, the balance sheet is for one specific point in time, end of the year, end of the quarter.
And it shows.
What the company owns its assets, what it owes liabilities, and the remaining claim of the owners, that's the owner's equity or stockholders' equity.
Following that accounting equation we mentioned.
Right. Assets must equal liabilities plus equity. They have to balance. And critically, that equity number on the balance sheet.
Well, let me guess it comes from the statement of owner's equity we just talked about?
You got it. That's the link.
Uh-huh.
The ending balance from the equity statement plugs right into the balance sheet.
Okay, so we have income over time, changes in equity over time, and the balance sheet snapshot. What's the fourth one?
The statement of cash flows. This one focuses purely on cash. Where did cash come from and where did it go over the period?
Just cash transactions.
Yep. It breaks it down into three types of activities. Operating cash from the main business, like sales minus expenses paid in cash.
Okay.
Investing cash used to buy or receive from selling. Long-term things like buildings or equipment.
Right.
And financing cash related to debt, loans, paying dividends, or issuing stock. How the company funds itself.
Wow, okay, so they really are interconnected, not just separate documents.
Definitely not. They weave together. The income statement feeds the equity statement, and the equity statement feeds the balance sheet. The cash flow statement sort of explains how the cash balance on the balance sheet changed from the beginning to the end of the period.
And this is where it gets really useful for you, the listener, right? Understanding these links.
Absolutely. It gives you a much more holistic view. You can't just look at profit on the income statement and think everything's great.
Why not?
Well, a company could be profitable, but maybe it's burning through cash really fast. You'd only see that by looking at the statement of cash flows, too. Seeing the connections helps you spot potential issues or, confirm strengths.
It lets you ask better questions.
Exactly. You see the bigger picture beyond just one number.
So, to recap, income statement shows profitability over time. Statement of owner's equity tracks changes in the owner's stake, linking profit to the balance sheet. Balance sheet is that snapshot of assets, liabilities, equity. And cash flows track the actual cash movements.
That's it. Different views, but all telling part of the same financial story.
Okay, here's something to think about then. If you looked at these connected statements, not just for one period, but maybe 2 or 3 years in a row, what kinds of trends might you start to see?
Ooh, good question. You could see patterns in growth, maybe how efficiently they're using assets, or perhaps if their debt levels are changing worryingly.
Right. Analyzing the changes in the relationships over time could reveal a lot more about the company's health and direction, something for you to chew on.
Definitely. It takes the understanding to another level.
We'll leave you with that thought. Join us next time on The Deep Dive.